Hey guys, welcome back to my channel, Lofi-Ledger, where I give you the market breakdown and insights from the perspective of a data scientist. Today, I want to talk a little bit more about modern portfolio theory. And the goal of this video today is actually to give you a better sense on where to put your money or how to allocate your portfolio in a way that makes sense for you. Okay, so personal finance is very personal. Everyone has different portfolios. What is best for you might not necessarily be best for me. But, there are ways to actually show that certain portfolios are more efficient than others, right? So modern portfolio optimization is basically a way where we can quantify what makes the portfolio efficient or not, right? So, if you guys didn't watch my previous video on modern portfolio optimization. Just a quick recap, what we're really trying to do is just get a portfolio that gives us the highest return for the least volatility, right? So an example is if you look at Bitcoin, um, Bitcoin is exploding up a lot, right? It's growing year on year. So like for example, in just in like bear to bull market from 2022 to 2025, that's 3 years, it went up almost um what 16,000 to 146,000, almost 7 8x, right, in just 2 years. But it has really big lows, right? So for example, the same low 2021 to 2022, that's a from 64,000 to 16,000. It's like a 5x drop, right? So even though it has huge gains, it has huge downsides as well. And you compare that to something like the S&P or gold, for example. Let's just look at the S&P. So for example, the S&P, um, the gains of the S&P is from 2009 is 800 to the present day is 6,000. So that's like also like a 5 6x 7x gain, but that's in the span of like 16 years. Yeah, 16 years, right? So Bitcoin has been growing much faster, but obviously it has bigger lows. What we want is really a portfolio that balances these two things, right? We get a portfolio that has really high gain, but you know, for every point of volatility, we want to punish that gain. So, for example, if you're gaining 1 point of gain per 2 points of volatility, that's gonna be like a zero point 0.5 ratio of gain to volatility, which is worse than if you get 1 point gain for every 1 point volatility, right? You want to maximize the amount of your gains that you're getting per point of volatility, right? So that's basically how modern portfolio optimization works. And you guys don't have to compute this yourself if that's what you're afraid of. Um, I created this calculator for you guys so that you guys can do it for free and you guys can have an idea of how to construct the optimal portfolio. So, first, how does this calculator work, right? So, basically, you have your universe of um, options, basically what you want to be invest in, Bitcoin, ETH, gold, and the S&P. Right now, it's everything. You can't untick Bitcoin and ETH. Sorry, because I mean this is primarily a crypto channel, so crypto has to be in there. Um, but um, but what this does now is that if you're selecting these are the assets that you want to consider investing in, this can give you an idea of how much to put on each asset, depending on how much return or volatility you want to receive. So, for example, you want to get you want to have a portfolio of like you want to make 100% year on year on average, right? Then it's just telling you that the only point that will give you that is 100% ETH, right? There is no combination of portfolios that give you that. But if you do go 100% ETH, you would have a 72% year on year return. but you would also get like an 80% volatility. So your volatility is even higher than um, your return. So the ratio of that, the thing that I was saying a while ago, is zero point 0.9. And I don't know if that's what you want, right? You are you willing to stomach an 80% return? Everything on this line is called the efficient frontier because it is the portfolio that maximizes your risk-adjusted returns. So just to illustrate this, for example, I just want to show you a different value. So for example, you want 50% year-on-year return. This is the portfolio that gives you the maximum risk-adjusted return. So that's a portfolio of 59% ETH, 25% gold, and 14% Bitcoin, right? Yeah, so that's how this works. But just to show you how it works on the other things, you can also put in actually your current portfolio or any percentage of weights, and you can see how to optimize that. So for example, let's say I have a portfolio of just an equal split of everything. So if you evaluate that, you can see the point, that point lies under, a little bit under this curve, right? So that means it's slightly inefficient, right? If I hover my mouse just over this point, you can see that the optimal portfolio that sits on the line is just slightly above. So if I double click that, you can see that this portfolio in the hovered point has the exact same volatility, but you're getting more gain, right? So just by rebalancing your portfolio to look like this instead of this, you're making an additional 1% return year on year. Yeah, so so that basically shows you that certain portfolios are inefficient. And to further illustrate this, you could just give like more drastic numbers, like, oh, you put 75% Bitcoin, 25% ETH, don't consider gold or the S&P. That puts you all the way there, right? And you can see that the optimal portfolio is on the line, and that gives you an even bigger difference, right? So this 75% Bitcoin portfolio gives you a Sharpe ratio of 0.8, right? While this one, which gives you a Sharpe ratio of 0.95, gives you almost 6% more return. Yeah, it gives you 6% more return for the same volatility, right? So this gives you ideas on how to structure your portfolio. For some people, gold or the S&P is not something that they would consider to be part of their portfolio. So if you don't want gold, then it'll give you a different efficient frontier that does not consider gold. And if you don't want the S&P, then it'll give you a different, if you're only in crypto like Bitcoin and ETH, it'll only give you that. Yeah, so this gives you an idea of what your portfolio's volatility will look like, which is pretty important because this gives you an idea of how much risk you can stomach, right? And risk is a very real thing. If you say you're okay with a 70% risk, be prepared to watch your portfolio go down 70%, right? But that might be the price you're willing to take for a 70% year-on-year gain, right? So you can't have everything, but what this does show us is you can optimize certain things so that you can get free return basically just by rebalancing your portfolio. Another thing I want to show you is how these values move over time. So this data is actually computed on a slice of data that encompasses from the start of the period to the end of the period, right? So what that really means is that this is using all the data, and therefore the portfolio that it's recommending is the optimal portfolio for the given data that it's seen. But the future isn't always the same as the present, right? So with that in mind, sometimes you want to see what this optimal portfolio would behave like if we run it through time, right? So since there's an infinite number of points here, we're only considering one optimal portfolio, which is the default blue point here. The default blue point here is the max Sharpe ratio, so it's the one that maximizes your risk-adjusted returns. Um, any point on this graph will be the maximum return for that volatility. But if you want to see the max ratio of all these ratios, it is actually the preset blue selected point. So yeah. So if we plot this blue selected point over time, and just not just the current value it is today, this is what it looks like. So you can see it does change a bit, but it's also a bit more stable, right? So for example, you can see that um, the current value is, it's saying 54% gold and 27% S&P should be on your portfolio to have the maximum Sharpe ratio. But what you can also notice is that these actually move with how the assets move. So for example, if I put in gold over here, right? Gold had this massive move up recently, and that's why it's saying that you should have a higher and higher allocation of gold because, the returns are going up, right? So if the returns are going up, then the ratio is going up for gold. And like this recent drop is also because of that recent drop, right? And so if you don't think that gold will have this huge run in the future, maybe this might not be super indicative of what you want gold's performance to be in your in your portfolio, right? So for example, if you think gold will be a bit more stagnant, maybe you're going to use this period in time wherein, gold did go up but it was relatively flat. So maybe the optimal portfolio in that case would be around, just 28% gold, and 44% stocks, and then crypto is the rest, right? So this is how to use it. What also I noticed here is that Bitcoin's pretty low in the percentages if you have everything on, and that's because it uses the low volatility assets to kind of anchor your portfolio, right? If you have an asset that has low volatility, it kind of anchors and stops the volatility of your other assets, and that's how it's sort of rebalancing it. It has this big assets like gold and the S&P that isn't so volatile. It's anchoring the volatility, and then that's why Bitcoin is a little bit less because ETH is giving more return but is more volatile. So it's using the big ones to anchor it. But yeah, if you're not gonna invest in gold or the S&P and you're purely in crypto, you're gonna see that it will recommend more Bitcoin than ETH. So right now, if you're just in crypto and you're only considering Bitcoin and ETH, it is recommending to have 57% in Bitcoin and 42% in ETH. So that's how you get an idea of how to really structure your portfolio. I'm mainly using this right now for the crypto thing, mainly because I don't have any gold or the S&P. I do want to scale into these eventually, but right now I don't think it's the time to buy. So right now I'm mainly use it for this. But if you do have gold in the S&P, you might want to use these charts to consider how to structure your portfolio in a way that makes sense for you. Another note is in the future, right? You're gonna want that, like I said, you're gonna want to have that future portfolio value. Just because it says 55% gold now, if you have 0% gold, you shouldn't like all in your savings to suddenly rebalance your portfolio. Yeah, that's not the way to do it. This 55% gold is based on if you had that portfolio and you held through this entire move, right? Or if you're experiencing the movement of this data. And that might not be the case in the future, right? So my suggestion is you could slowly scale into the assets that you want depending on how much capital you have, but also take into account that certain assets might be overvalued. So if you think it's not the time to buy gold, so for example, I don't have any gold right now, but I do want to scale into gold. But since I don't have any gold and I don't think it's the time to buy gold right now, I'm just looking at rebalancing based on these. And if I think it's time to buy the S&P, then I will slowly scale into the S&P, with the end percentage in mind to be somewhere between this 60% and my future maybe gold allocation, um, if I see that. And so the reason why I'm not buying gold right now is because it has had an insane run up, and I'm not sure if it can continue that, so I'm still looking at it. But if I just go to one of the other metrics that I was tracking on the rolling, yearly gains, gold, these graphs seem to be mean reverting, and you can see gold is way above its mean, right? Of course, there were periods in time where it got much higher, but these were like the 1970s. Um, yeah, so it could continue to go up, and if it does, then I missed the boat. Oh well, that's investing. You can't time everything perfectly. But, I'm probably consider if gold went back down here. Although those moves could take really long, right? So for example, it broke it in 2024. The last time it broke it in 2019, it went below it in 2021. So that was a 3-year move down. So at the shortest, maybe it'll take 3 years, but there are some moves that take much longer. So this one was in 2002, and then it went down in 2005. So that's like 3-4 years, right? So it really depends. I'm still looking at the charts and trying to see when I can enter gold. Um, yeah, but right now, this is how you get an idea of how much you should allocate to different assets. It's not perfect because, yeah, it gives you the optimal portfolio for the historical data, but you still have to figure out when you're going to rebalance and what makes sense for the future, because historical doesn't always mean that's how it's going to play out in the future. But yeah, that's how I would do it. If you guys are interested in using this calculator and seeing for yourself how your current portfolio stacks up in the efficient frontier and what kind of rebalancing you guys might want to do, this site is completely free to use right now. So head over to Lofi-Ledger.com. Yeah, and if you find value in this video, like and subscribe, and I'll see you next time.